Good morning and welcome to Weekly Insights by John Plassard with Cité Gestion. As the Christmas holidays approach, here is our 2026 wish list. Not a dream, but a macro financial roadmap built on what we believe could carry markets into the next cycle. Our first wish is that recession does not show up in 2026. Despite repeated forecasts of a downturn since 2023, the US economy continues to expand, fueled by resilient consumption, strong household balance sheets, and real wage growth turning positive again. The tariff shock was largely absorbed by corporate margins, and the pullback of early 2025 was followed by a solid rebound into Q3, suggesting that demand remains intact rather than exhausted. If recession risk fade further, visibility improves, investor confidence strengthens, and risk-taking become a rational allocation choice, not a speculative one. Our second wish is that the end of quantitative tightening, QT, delivers oxygen to the market. The stop of QT was largely overshadowed by rate cut discussions, but history reminds us how powerful this turning point can be. Less balance sheet pressure, easier liquidity transmission, tighter spreads, and faster risk appetite recovery. If liquidity ceases to drain, equities could benefit more than from monetary cuts alone. A silent but decisive tailwind for global allocation flows. The third wish is that AI continues to prove itself as both a technological and industrial revolution. This is no longer a theme, it's a structural productivity engine. Data center capex, semiconductor expansion, cloud infrastructure, and robotics are accelerating into 2026 with profitability high and self-financed by cash flow rather than debt. Productivity gains offset labor and tariffs costs, broadening market participation beyond mega caps and bringing industry, cybersecurity, and energy into the next wave. If AI diffusion continues, margin and innovation cycles remains powerful equity drivers. Our fourth wish is that the Federal Reserve maintain a true preemptive easing path, not under pressure from politics, labor market, or inflation noise, but by choice, to smooth the cycle before damage appears. Gradual, predictable cuts could avoid the classic too late, too fast policy mistake and anchor soft landing probability. A cautious but proactive Fed is historically equity positive. Our fifth wish is that oil prices avoid a sharp rebound. A stable barrel means contained inflation, calmer transport and service prices, and more room for monetary easing and the ideal backdrop for long-duration assets. Our sixth wish is that bond and equities advance together rather than diverge. At current yield levels, bonds finally offer real return potential, reducing volatility in portfolios and restoring diversification efficiency. When both engines run in the same direction, as in 1995, 2009, and 2019, market momentum becomes difficult to stop. And the seventh wish, to keep seeing the glass half full. Because cycles are shaped not only by data, but by interpretation, sentiment, and confidence. If 2026 aligns profits, liquidity, AI innovation, and policy stability, optimism ceases to be a wish and becomes a strategy. Thank you very much. Have a great week. Stay safe and keep on winning.